Welcome to the next module. In this module, I'll go over LEAPS options, my personal favorite strategy to run, and all LEAPS stand for is long-term equity anticipation securities, and this is just an option with an expiration date longer than 1 year. So most of the time, the expiration dates for LEAPS are going to be between 1 and 3 years. So anything longer than 1 year will be considered a LEAP option. And the reason that you would trade a LEAP option is because theta is going to be lower than if you were closer to expiration. So with options that are longer than 1 year, the theta is going to be very low, meaning your time decay is also going to be low and you won't lose as much for holding the contract. So this is a really great strategy, an alternative to owning 100 shares of stock, because you do get that leverage for a discount and then you don't get as much time decay or theta decay. So you can also run income producing strategies that pay you out every single week, every single month, or every single quarter with using LEAPS options. So I'll go into that, but this is my personal favorite strategy, and this is how I was able to make money this year trading options. So let's get into it and talk about the pros and the cons of running LEAPS. When trading anything, it's important to talk about the pros and the cons, so let's talk about it when it comes to LEAPS options. The first pro for LEAPS is that there is little theta decay, so the longer you go out in expiration, the least amount of theta decay or time decay there's going to be. So your option contract is going to hold its value if it's longer than 1 year. So that's the first pro of trading LEAPS options. The second is that you get to hold quality companies. So how I run my LEAPS is I like going with blue chip stocks that have a lot of volume, are extremely popular, and are always going up and to the right, because I want to take advantage of the fact that it's a great company. It's always moving in my direction and in my favor, and taking advantage of that, the small theta, and then also the long time until expiration, I can capture those big moves. So that's the second pro of trading LEAPS. The third pro of trading LEAPS is that you can manage 100 shares of stock for a significant discount. So if you buy a LEAPS option, it's going to be discounted versus buying 100 shares of stock. So essentially, you get to control 100 shares of stock for a fraction of the price. All right, let's go into some of the cons. The first con of trading LEAPS is that it can expire worthless. If your LEAP is out of the money, meaning the price of the stock expires higher than or lower than your strike price, that means that your contract will expire worthless and you will lose all of the premium that you paid for the contract. So this is definitely a real possibility when it comes to trading LEAPS, especially because you're paying upfront for that contract, and then if it doesn't go your way, then you can lose everything that you put into it. So that's the first con of trading LEAPS. And then the second con of trading LEAPS is that it has pretty big bid-ask spreads, meaning where you buy in is going to be, say you buy in at $1,000. If you need to sell that contract, you might be able to sell it at $990. So that's a 10% or $10 spread. So with long-term options, you're going to have bigger spreads, hundreds of dollars, sometimes even thousands of dollars. So that's why it's a huge, it's super important to get contracts that have lots of volume. But that's another con that comes with trading those LEAPS, is that you're going to have larger bid-ask spreads than if you were trading traditional stocks. Now let's move into how you can use them for bullish and bearish trades. Let's go ahead and go into an example here so that you guys know exactly what I'm talking about. So let's say I pull my chart up, and right now, like, let's say I'm just starting. Like I'm like, I have no idea what's going on. I want to get into a LEAP option, okay? Essentially, this is if you want to take advantage. Say you don't have a huge account, you can't purchase 100 shares of stock, but you think that the stock market is going to go up over the next 2-3 years, right? It usually does, especially if you're trading something major like SPY, Nvidia, Amazon, Google, right? So let's say you come over here to your watch list, right? I'm going to put my screen away. Let's say you move over here and you have your watch list, right? And you're like, okay, well, I think NVIDIA in the next 2 years is going to be higher, right? So what you're going to do is, actually, I kind of wanted this up. So what you're going to do is you're going to come over here. You're going to pick your NVIDIA, right? You're going to go to all products. You're going to see your option chain, okay? So when looking for an expiration, you're going to look for something that's longer than 365 days out. So I even like going further than that. So I like coming out to about 2 years. So 720 days will be perfect for this example. All right. And what I like doing from here is I like looking at the delta. Okay. And I also like looking at, we can look at volume and open interest. Open interest is, there's a lot of open interest, okay? So I'm not really too worried about the open interest. Like I'm really not too worried about this because it's NVIDIA. Like it's a great stock. It's got high open interest. You can see that these are all in the thousands for the most part. So I wouldn't really worry about this too much. The second thing that I'm looking for is I'm looking at the delta, okay? Where did it go? Oh, it's right here. Okay. So I like 0.7 if it's a closer expiration date, but because this is further out, like it also depends on your budget and the price, right? So if your budget is you're only working with $6,000, this one would be perfect because this one's about $6,000, okay? But if you want more safety, then this one's gonna be about $7,600. So that's something to take into account. But I'm looking for 0.7 and I'm looking for 0.8 delta is usually what I like. And I want to be in the money. That's what this is called. This is called in the money. And this is called at the money when you're at the price. And then out of the money is over here where the price hasn't even hit yet. Okay. So this is in the money. This is out of the money. Okay. And when you're in the money, you have intrinsic value. So that means if your option expired today, you are going to walk away with some sort of money. You're going to get something back, okay? Your contract will not expire worthless unless the price went below your strike price. Then it expires worthless, okay? So let's say, for example, I like this one right here, okay? Say I want to go safe. I like this one. The strike price is 145, so you can do the math between 145 and 188, and it'll show you exactly how much, if it expired today, you would be you have in that option. So essentially, you have about $4,000 that is in intrinsic value. Okay, you have about $3,500 that is in extrinsic value. So that essentially just means that the stock price in 2 years needs to go up, where is it? Like $35, and you will break even, okay? And then everything else above that, every $1 is going to give you $100 in return. So that can be really huge if there's a huge push. But you have 2 years. So typically these are moving up and to the right, and 2 years is a long time. So I'll go ahead and show the risk graph, the risk profile graph, so you can see like what your profit potential could be. So let's say I pick this one right here. It's going to be about $7,600, right? And I'm going to analyze it, okay? So if I come over here, you can add the simulated trade. So I added it here, okay? Now if I come here to my risk profile, I can add a simulated trade. So I come to analyze, add simulated trades. This is the one that I want to add. So I want to see what it would look like if I were to purchase this one, okay? So I'm going to come over here. I'm going to look at the risk profile. And as you can tell, if you look at the blue line right here, this blue line right here, you can see that my loss, if the price goes below 140, It should be 145. If my price goes below 145, I'm going to lose my premium. So I lose all my money. This is at time of expiration, okay? You can see the stock price at the bottom, and you can see what would happen if it goes to it, and then you can also see your profit and loss potential right here. Okay, so the max you can lose is 7,600 because that's what you're paying for the option. Okay, this purple line right here is by a certain date. So this is the current date today. So if the stock price went from 188 where it is now, and it came all the way down to 140, you would only be down $3,500. So that's what it would look like if it were today. That's a huge move. That's a $48 move, likely not going to happen. But you can also see the profit potential. If you think the stock is going to get to $250 in that many years or within that time frame, you can see your profit potential right here. So at expiration, that'd be about $3,000 profit. Okay. And you would say 250. Yeah. 250. You'd make about $2,800 in profit. And if it did that today, it'd be about $5,000 in profit. So you'd make a pretty decent return on that, especially for only risking about $7,000. You can make a ton of money, especially if the stock goes nuts, and it just keeps on going. And you can just play with this and see the potential. But that's what I would do if I was looking at a stock. For example, let me pull out a calculator here and do the calculations right now, because I want to calculate if, say, the stock went up. I don't know what's normal. It's Nvidia. What did Nvidia go up last year or this year? Let's see. And this is for 2 years too. So Nvidia went up 27.8% this year alone. Let's see if I can do one for, actually, I can just pull it up here. Let's do this. 3 years, 1 week. Okay, 2 years ago. So today is January 23rd. So let's go back to, where is this? This was, okay, so this is going to be January 22nd. So we'll go from right here. Yeah, this is nuts. Nvidia is done insane. So let's just say you held this option back then 2 years ago and it went 200%. That's insane. Like 200% is kind of nuts. It's likely not going to do that again, but we'll just use it for this example. Okay, so 200%. Oops, what is that in like dollar values? Well, now it's saying like 170%. Okay, let's use 150%. Or this was, okay, that's where it was. Okay, 200%. That's why I saw it. Okay, 200%, about $126 gain. So let's do 200% from where it currently is right now. So currently it's at, 188. All right. Let me do this. 188 times 200%. Okay. I don't know if you can see this, but if you can, that equals $376. All right. Would that make sense? Wait, no, that wouldn't make sense. That'd be a gain of $376 because 100% would be another, it'd be double basically. Okay, so I just need to add 188. If it did that, it'd be $564, which is kind of nuts. It's probably not going to do that. But let's just say it went to 500, and I got to put this down more. 564. So 564. You can't even see it. But if you look at the number, it'd be about $34,000, give or take. Yeah, about $34,000. So that would be your profit. You know what I mean? Like, that's kind of nuts that your profit would be $34,000 on top of your like you put your $7,000 in, and then your profit is $34,000. That's an insane return in just 2 years. But yeah, overall, that's all I would do. And this is essentially just for you to be able to leverage your money. It's not going to leverage as much as if you were out of the money. I like being in the money so that I'm making sure that I'm saving some of the money that I already have, because I don't want to risk everything, but I still want to make those outsized returns. So that's what I use Leaps for, usually by 1 to 2 years out. And I also recommend making sure that you sell the Leaps if you're in a profit and you've made the return that you want to make. I recommend selling before theta kicks in. So I usually recommend before 90 days until expiration that you just close the position. For risk management, when it comes to Leaps, I let my Leaps die nobly. So if I'm at a loss with my Leaps, that's usually what I've allocated. In my head, I'm like, hey, I'm expecting to lose this once I put it in. So if it doesn't go my way, I let it expire. And I let it expire at a loss if it doesn't go my way. But you let your runners run too. So I usually like closing out. If I'm happy with the return that I've gotten, I'm got like a 3x, 4x, 5x, I'm going to close it out about 90 days until expiration before theta kicks in and I start losing significant value. But if I'm red, I'm just going to hold it, and if it dies, it dies. I'm not going to try and time the market. If it goes back up, it does, because it's happened before. But if it's going to die, just let it die nobly and just let it expire worthless, essentially. Um, because that's the game that you play with Leaps. You're going in with significantly less buying power, but you're taking advantage of the upside potential. This is my strategy when it comes to Leaps. So let's talk about what happens if you think the market is going to go down within the next 1 to 2 years, and what that looks like and how Leaps can actually help you on the downside. So let's get into that. The next way that you can use Leaps is if you are thinking that the market is going to go down within the next 1 to 2 years. I'm just going to say off bat, I wouldn't recommend this at all. I just want to make sure that you guys know that it is an option. But essentially, a put Leap can act as insurance for your account. So if the market is, say, overbought, and you're like, maybe I think there's going to be a correction, what you can do is you can buy a long-term put, and essentially this acts as the same way that a call would, just on the downside. So usually stocks go up and to the right, and that's why I wouldn't really recommend this, but it acts as insurance for your account, and it's just a good way to hedge your portfolio. And essentially you would do this the same exact way that if you were doing a long-term call. Essentially you would come over here, make sure your delta is about 0.7, 0.8, and you would buy one of these as insurance for your account. And essentially it would be the same exact way. I definitely would not recommend doing this on a super volatile stock. You can do this on something that's like, say, SPY or Amazon, and SPY or QQQ, but I wouldn't recommend doing this on something that moves insane, because it can move your way it can move against you very, very quickly. But essentially this just acts as insurance just in case there is a market, a drop, a pullback, or even a recession. So I'm not going to get super into it because it's essentially the opposite as a long call. But stocks just move up and to the right, so I don't see any point in doing it. I don't like hedging because it feels like I'm kind of throwing money away. But that's me personally. It is always an option for you. And if you do want, less expensive contracts, you can come over here and you can, buy one of these, for example, just in case the market does pull back. But yeah, just wanted to give you guys that option. Essentially, it's the opposite. You find a long dated expiration, 1 to 3 years out, and you just buy a put as insurance. But that's typically if you have a large portfolio and you really don't want to lose money and you don't care about a couple $1,000s, that's probably a good option for you, because if the market does move down, it's going to help you hedge significantly more than anything else. All right, so for this one, I'm going to use SPY because I like trading SPY more, and I'm gonna come out. I like these January dates because there's usually a lot of open interest on the January dates or ones with further expirations. So I'm going to look at my volume and open interest. I'm going to open interest on this one's pretty low actually. Let's see if there's one with more. Yeah, most of these are going to have lower open interest because it's so far out and people don't want to pay that much for them. Like that one's 1,000 days. Let's see this one. December. Mostly I see a lot of people buying January ones. Okay. I think I am going to go with the January. Something else too, over time the open interest will gradually increase, and that'll also increase the value of your option. So I think I'll do, let me check. See, the bid-ask spread on these is about $100. So I'm just looking for something that's lower than that. This one's less than a year, so I don't want that one. The open interest is a little bit higher on it. So what I do is just kind of look through these and just kind of pick and choose what I want. I think I am going to go January. I really like January expiration dates. It kind of keeps everything neat. So once I know that I'm going to do January, I'm going to do this date. What I'm going to do is I'm going to look at my deltas. 0.7 delta is what I'll do. Usually if the market is like really terrible, like I don't know, like COVID recession, or when Trump put those tariffs in place and was like 100% tariffs on everybody, the market literally just tanks. So what I like doing is I like coming out here and I like going 0.3 delta because it's significantly cheaper. But when the stock does correct and it goes back up, your returns are insane. So I usually like doing that. If the market is kind of overbought, I'm not going to do that because I want to save myself some money, some intrinsic value. So I won't do that. I'll only really do that if the market has come down significantly. So like 10%, 20% pullbacks on SPY and QQQ, like the entire market. Like things like Nvidia, Apple, and Amazon and Tesla are down like 40, 50%. That's usually when I'll do it because the returns are nasty. So I'll usually come here, I'll go 0.7 delta. This is probably the one that I would buy right here. Let me check. Wish I had the open interest. Okay, now I can see my open interest. So a lot of people have been buying this one. That spread isn't terrible, but I don't like that. These are kind of buns. Let's see if I can find a different one. I really want to keep it over 1,000. I want to keep the open interest over 1,000. That's what I really want. But if I can't find it, then I might not be able to. Let's see if I can find it on QQQ. That's 0.7 delta over 1,000. So yeah, I like this one. That's a big bid-ask spread. Oh my gosh, $500? Yeah, that's what that is, right? Wait, yes. 11,500? Yeah, that's about $500. So I want to keep it as close as possible. What is this? Let's see what it is. It's about $200. You know, I can't be mad at that. I can't be mad at that. See, I don't want to pay significantly more than what it would sell for. The open interest on this is terrible. Yeah, it's actually terrible. Like, I loved what it looked like on Nvidia's. Why is it so bad? See, it does get better on these. And usually this increases the price too, so. And most people aren't buying 2-year options anyways because literally they're so expensive. Like who wants to pay $1,000 for one option? Not many people do. So yeah, it's gonna be about $200 regardless of what I do. These are about $200. So I'm gonna go with this one. I like 0.7 delta. The open interest on it sucks, but I know it's gonna go up over time because usually like 650, 640, like those numbers or the strike prices that have like, I don't know, like 600 will probably have a lot. 700, where's 700? Yeah, that'll have more. What's this one? 680 has a lot. Since these are so far out, you could low-key get away with doing something like that, but I'm just gonna stick to this because it's not bad. So what I would do is I just go ahead, go to one, if that's my budget. If this is too expensive, then you can find something else that moves up into the right. So like I was showing the Nvidia ones, like this one's honestly like not bad. Like $6,000 for an option that expires in 2 years and is already in the money. Like this is not bad. Like this is actually pretty good. The open interest is 11,000. Like honestly can't complain with that. Your theta is pretty low on it. This one's honestly a really good option. But just for the sake of this example, I'll go ahead and go with this one and I confirm and send it. Actually, let me see if I can get a better price on it. So what I'll do is I gotta go back to SPY. Bless me. What I gotta go back and do is I'm going to right click and I'm going to send it to this one right here. So you can see that this chart looks absolutely terrible because there's not a whole bunch of people trading it. And like that's what this chart's gonna look like. It looks bad. But you can see before it was worth $9,000. Now you can see it's worth $11,000. So what I'm going to do is I'm going to, good Lord, I'm going to try and get the best price possible for it. And over here, if I trade it here, if I go ahead and buy it at a limit, it's going to be $1,561 is what the price is going to be. Or $11,561. I want to beat that. I want the best price possible. So I'm going to try and buy it closer to 1,400. So if I buy limit, I'm going to delete this. I want to edit this. I'm going to only put one. I'm going to have auto send. And what I'm going to do is I'm going to slowly oops, went too far. I'm going to put my limit here and I'm just going to slowly move it up until I get filled so that I can see if I can get the best price possible. Because 1561 is where it was before, but I'm just going to keep on moving it up and see if I can get filled. And did it fill me? Why did it say canceled? What happened? Where did it go? Canceled orders? It says canceled. Okay, let me try that again. All right. And I'm literally just going to keep moving it up until I get filled. $1,567, where's the 1573 is where it is. I wonder, it might not fill me closer. I'm just going to try and get the best price possible though. Because you can see where it's trading here, so I'm just going to slowly move it up, see if I can get a better price. Because this is on a simulated account, it's not as accurate as like if it were a real account. Oh, there we go. I got filled at 1480, so I got filled at a better price than I actually put in anyways. So if I would have purchased it at 1500, I would already be down, I don't know, 60 something dollars. So, or even more, 80 something dollars. So essentially by doing that, I'm just trying to get the best price possible. I want to get filled because that's going to save me an extra 80 bucks, you know what I mean? But essentially that trade cost me about $11,480. And oh my gosh, that's the process that I would use if I was actually going and buying an option. And to be honest, the Nvidia ones look really good. So that's something that I would do if I was going to buy Nvidia, is I would just go here, copy this, go to active trader. My gosh. Paste it there, look at it. You can see that this chart looks way better. Let's see if I can get. You can see that this chart looks way better. I go ahead and purchase this. Okay. I come here, buy limit, and I just keep moving it up, see if I get filled at a better price. Because right now it's at like 58.60, and now I'm just trying to get better price for it. And then I slowly move up. But once you're in this contract, you're literally going to be in for probably like a year or more. Like, you're essentially until expiration, or 90 days hits and you're up like 300-400%, and you're like, you know what, I made my profit, I want to de-risk, so I'm just going to sell and I'm going to do it again. So you just close your position and then you go look for 2 years expiration and you do it again, and you just keep doing this. Make sure you're in the money, 0.7, 0.8 delta, so that you actually get intrinsic value. But essentially that's all it is. It's not super complex. It's relatively simple, and you can get some pretty great returns doing it. Let's talk a little bit about the poor man's covered call and why it's called the poor man's covered call. So essentially it's the same thing as a regular covered call, but it's just significantly cheaper. And with a regular covered call, you need to own 100 shares of stock, and you are essentially just selling calls against it. But with a poor man's covered call, all you're doing is buying a LEAP option that's in the money, and you are selling calls against it. So now, in the example that I gave previously, I purchased a call, a LEAP. So what I'm going to do now is I'm going to show you exactly how a covered call, a poor man's covered call works. So in my chart here, you can see that I have Nvidia and SPY. And what I'm going to do is I'm going to come over. It's essentially very, very easy. So let me hide all this stuff. So we'll start off with the Nvidia one, okay? So I'm in an Nvidia LEAP, and I want consistent income. That's what covered call strategy is. It's consistent income. I want monthly income. I want to get money in my bank now. All right? So all you're going to do is you're going to, we have 700 days until expiration. But all you're going to do is you're going to come out to about, say you want to get paid every 30 days. You can come out 30 days. And Nvidia is currently at $187, almost $188. This is very important. So our strike price is 180. When we sell the call, we need to be, our strike price needs to be higher than 180. Okay? And we're going to pick an expiration that's about a month out. We're going to have a strike price that's higher than 180, okay? And you're going to come out, and I like looking at the delta and theta again because I want to see how I want to make sure that theta is higher and I want my delta to be lower, okay? So actually I'm going to do it shorter. I'm going to do 2 weeks. So you want to get paid out every 2 weeks, okay? And you don't think Nvidia is going to get to $200 within 2 weeks. So you just don't think it's going to do that. You have a 80% chance of being right with this. What you're going to do is you're going to come over here to the $200 strike price, okay? And all you're going to do is you're going to sell the call against it. And make sure you only are selling one. You don't want to sell 10. That's an issue. And in order to run this strategy, you're going to need a margin account. You can do that by applying for a margin account through Charles Schwab. So there's level 1 through 4 options trading. You'll just go to level 3 is all you need to run poor man's cover call. You're not using margin in this strategy. That's not essentially, you just need a margin account to be able to run this because you're selling calls. So anytime you're selling calls, you need margin because you have a set profit, but you have infinite loss. But what's helping with that infinite loss is the infinite gain that you get from that cover, from that LEAPS option. So essentially all you're doing is you're going to come over here. You're going to sell one. And if you look at my cash and sweep vehicle, I have $82,675. And you're just going to confirm and you're going to send this. Okay. It instantly adds it to the account. Okay. I got an increase of $127. And you can see it right here. I have my 200 call that I've sold. Okay. You can see that I'm up $2 on it right now. But the cash was instantly added into your account. You want this to expire worthless. Essentially, with this strategy, you're making passive income every 2 weeks because you want this to go to zero. You still want Nvidia to go up overall, but say your LEAP isn't moving as quickly as you want it to, and you're like, you know what, I need more money. This is you renting out your place. You just paid for a condo with that LEAP option, and then now you're just renting it out. That's all this really is. It's just you're buying a condo and you're renting it out. So you're just making $100 every single time, every single 2 weeks, just as income. And you got to think about it. This is about 100, or at the end of the month, that's about $250. And you spent for that option, it cost $5,000. So your return is pretty good. Let's calculate what that would be. About a 5% return. So every single month you're getting an extra 5% on this just for selling calls. So that's another great way to make money in options, is to go ahead and sell calls, and it gives you the money instantly. This is essentially cover call strategy, but it's just poor man cover call. Like, you don't have money, you're broke. So you just buy a LEAP and then you sell calls against it and it makes you rich. It's not as simple as that, but that's essentially the point of it, right? And you can just keep doing this over and over and over again. I like selling at a profit of about 50% on this. So when I go here, I'll buy it. I buy it back because that's all you're doing is you're buying it back. And I'll go ahead and put $60 or 0.60. Oops. Let me show this. 0.60. 0.60. Okay. And I'm going to confirm and I'm going to send it. And whenever it gets to 0.60, so it loses 50% of its value, it's just going to close the position and I'm going to make my money. The reason I like doing that is because I don't want it to get all the way to zero, and I don't like holding this super long. I want to hold it for a couple days and just get out. I want to collect my money and get out. And you can run this over and over and over and over and over again. And it's essentially you just running out your place. Um, so pretty good way to make money. I like selling it at 50%. You can wait until it hits zero and make the full 120. Um, but I like doing that because then the moment it closes my position, I can just get into another one. Um, like it may hit 50% in, I don't know, 3 days. It could. And then I just get into another one. So I just keep moving the expiration date every single time. Every single time. I can even run this on a weekly basis and say I want to make 36 bucks on it, right? You can see that the 200 call is now $36, where this one is $127. So they lose value because of theta, right? Essentially, you're making $13 every single day if because the contract isn't going up in value or the stock isn't going up in value. So this is a great strategy if you have leaps options and you just want to make money on them. I'll do the same thing for this one on SPY. Okay, so I have the SPY leap that I purchased. If I go here, I go to SPY, you can see that I have it here. Let's look at the strike price. I'm gonna scroll all the way down. My strike price on this is 655. Okay, so all I'm gonna be doing is I'm gonna sell calls at about 14 days out. 655 is, oh my gosh, it's all the way down here, but I'm gonna be selling them out here. Okay, so I'm gonna look at my delta. Sometimes I like going 0.1, but 0.2 is fine, and I can go ahead and sell this one. And now I have made 100. Oops. Hide this. Now I've made $172. Okay, it's instantly going to be added up here to my account. If it fills. Okay, filled. And you can see that it got added here. And now I have made $1 on that one. But this is a good way to make money every single time, because say I don't think SPY is going to get to $702 within 14 days, then I'll go ahead and sell this one and make some money off of it. This strategy is very, very similar to the wheel strategy. It's essentially taking the wheel, cover calls, and then cash secured puts and just putting it all together with a leap option. So it's very, very simple. You're just buying a leap and you're selling calls against it. That's all you're doing. And you're just collecting that income every single time. Income. And what it's doing is it's bringing down your cost basis. So for NVIDIA, the leap option was about $5,000. Now it's slowly chipping away at that because every single $100 is adding to it. And essentially that means you can have a leap option for free if you continue doing this every single week, every single like bi-weekly or monthly. You can keep on doing that, and then eventually your leap option can be essentially free. And now you have a leap option because you've made your money back from that rent. So this is another great strategy, especially for beginners. Super, super simple, and you can make a lot of money doing it.